Did the economy grow in the December quarter?
It did, Gemma. There was some concern this week when the partial indicators were released ahead of the GDP number that we might see a contraction in the December quarter because there was a big fall in inventories, for example, which means companies were destocking. But in any case, we saw some better data out yesterday, which pointed to growth in exports, which would add to the GDP, which it has. So in the quarter, we've seen GDP growth, if you like, of 0.2%, which has taken the annual growth rate to 1.5%. Now, that is a slowing from the previous quarter. We've come down from 2.1% now down to 1.4%. But in any case, it's broadly in line with expectations. The fact that the Australian economy did grow in the December quarter, the 3 months to December, is obviously positive news. When you look at per capita GDP, that's the amount of output that the economy has made, if you like, broken down into individual people, it is again negative, and that has been the case for the last 3 quarters running now. When it comes to real net disposable income, that's actually risen in this quarter. It was negative in the past two to now being in positive territory, 1.4%. So look, there's some interesting things going on in these numbers, but the real takeaway is the fact that government expenditure and business, private business investment and domestic demand, government expenditure and private business investment helped boost the GDP in the quarter, whereas domestic demand continued to slow as households, as we expect, have been cutting back on discretionary spending, and investment slowed in the following 3 quarters of growth as well, as I just sort of read the data coming in from the ABS. But someone who is probably better placed to give us a bit more context is senior economist at ANZ, Adelaide Timbrall, and she joins me now. Adelaide Timbrall, the number is broadly in line with expectations, would you say?
Yes, that's right. We at ANZ and other economic forecasters did expect a pretty weak GDP growth number for the last quarter of the year, and we expect some weak numbers in the first half of this year as well. But it's not all bad. What we're seeing is some really good signs for inflation. So household consumption of discretionary items, so everything other than, your groceries, your rent, your fuel, your utilities, that went down even though we had population growth. So even though there were more people, there was less spending on discretionary products. That's telling us that consumers are cutting back. And when households are cutting back, businesses have to work harder for each dollar they make, which means it's more competitive, which means that prices rise more slowly. So for the Reserve Bank, this is going to be an encouraging part of that GDP growth. We also saw that the household savings ratio increased. This means that people have saved a higher proportion of their money compared to last quarter. Part of that is because it looks like tax returns were coming in a little later last year than usual, and so income tax payable was lower. But we also saw a good increase in average household incomes, and we're going to see a lot more of that in the second half of this year once we get the tax cuts, as well as a bit of wage growth, less inflation, and of course the first rate cut, which we expect will be in November.
So those interest rates that we've seen increase, encouraging people to hang on to some of their money if they can. What do you make of the per capita GDP? Whilst this data showing the economy slows might be good news for the RBA when it comes to potential rate cuts, it might not feel very good to many people out there.
Yeah, we are in a point, and this has been going on for the last 3 or 4 quarters, where economic activity is getting smaller per person. So we are going backwards. But I think we have to remember that we're going backwards after this really huge boost through 2021 and 2022, where we actually had some record figures for per capita growth. So if you sprint really quickly in one direction and then you take a few steps back, you're still ahead. And so we are just unwinding this incredible growth from the post-COVID period rather than really seeing like a huge step back. Of course, for some people, it is going to be a step back. Not everybody has the opportunities to have gone forward in the first place. So So, when economic activity is sluggish, it does hurt people. Luckily, what we have is a really strong labour market, super low unemployment rate. That's going to continue. Compared to the past 50 years, unemployment rate is really, really low. Most people who want a job will have one. So things are tough in some circumstances, but are easier in others.
Yeah, and of course, we don't have the opportunity to look at the data from a granular perspective. This is in aggregate. What will the RBA make of these numbers? Will it shift the dial on rate cuts?
I think this is going to be a real comfort to the Reserve Bank. GDP is growing. We're not at risk of a recession based on this data, so they don't have to worry too much about stimulating the economy, particularly when they know those stage 3 tax cuts are right around the corner. And they're about the equivalent of 2 rate cuts in terms of their stimulation of economic growth. But also, it's not going to necessarily concern them and make them push back a rate cut because what they're seeing is that inflation, the transmission of reducing inflation is working. We've got lower consumption. We've got people kind of slowing down a little bit on the investment side. What we have is an economy that is listening to that Reserve Bank and saying, okay, it's time to be a bit cautious. It's time to put a bit of money away rather than spend it. And that's what this weak GDP looks like. So it's not weak enough to be a problem, but it is weak enough to be the solution in a way when it comes to inflation this year.